The following was recorded in front of a live studio audience at the Studio 21 Podcast Cafe. This is the United Podcast Network.
Welcome to Tell Us Why, a podcast for the financial freedom community. If you're looking to succeed in your quest for financial freedom, make sure you join us every week as we, along with our guests, discuss different stories of success, how they were achieved, and how you can do the same. And of course, we ask them to tell us why. Here are your hosts, Jack and Mike.
Welcome to the Tell Us Why podcast. I'm your host, Jack Dalrymple, here alongside my co-host, Mr. Michael Ketchen.
How we doing?
How you doing?
Good.
Feeling nice and relaxed a little bit?
Yes, excited to get back in some Airbnb stuff. And
Couple
get
weeks in
after
Greece, no big deal.
No big deal.
But yeah, like as Mike alluded, today we're discussing Airbnb investing, part 2, as another addition to the Financial Freedom series here on the Tell Us Why podcast. A little different today. We have a little surprise
Appearance.
Nugget, special guest who's going to drop some tax/Airbnb knowledge bombs on us, I think.
I think so.
But before we dive into that, Mike, what's going on with the business?
Things are good. We sold the property today, completely remote.
Sold
the property remote while we were in Greece too,
properties?
which is pretty great. Some small stuff and working on stabilizing, refining a couple deals. Things are good. Finally looking at the laundromat, getting that up and running. What about you? What you got going on?
I sent you a laundromat the other day.
I saw that.
Okay, we're going to talk
It was in
about
Massachusetts, so we don't invest there.
Oh, right. Refis, all about the refis. Had a little bit of
Refis or
issue.
relationships, the two
Refis
Rs.
and the relationships. One's looking really good, refining my primary residence.
Yep.
So doing that, potentially throwing a HELOC on top of it if I can do that.
Going from a liability to an asset.
Big time.
Financial
Big
freedom
time. I
series.
have a HELOC on it already, but I'm going to cash out refi, pay that HELOC off, and then
Look at that.
get some big chunk of change with it on
Putting
top
money
of it.
to work.
So, yeah.
I like it.
But so let's get the show on the road.
Let's do it. Let's jump in.
All right.
Are you sick of being treated like just another number by large insurance companies? Do you want a more personalized experience with somebody that you can trust? With Keith Monteith, that's exactly what you'll get. Keith is an experienced professional who can design an insurance plan tailored to fit your specific needs. With access to over 30 insurance carriers, Keith is able to shop numerous markets to find a price that works for you. So if you want an insurance agent that you can rely on and one that has your best interests at heart, then call or text Keith today on 978-241-2363. That's 978-241-2363. Keith Monty. He'll get you covered.
All right, so quick Keith Monty.
Every week.
Dude, he's coming up huge for me right now. We're working on a couple of things, but
He's unbelievable. Get him on someday too.
definitely. We want to tease the December event, or no? We're gonna wait.
Maybe we'll wait a little bit.
All
Check
right.
out your social media. Something big's coming, which we're excited about.
right.
But what I want to say, the reason part 2 for this, and we did the webinar on Airbnb investing, is, as we mentioned last episode, is I think this is potentially, in my opinion, the quickest path to financial freedom right now in the real estate space. However, it does come with risks. You are still investing. We can't, downplay that. And one of the goals we're trying to do here with the resources and the systems we're sharing and the opportunities are talk about some of those. So I know last week we started to talk about the returns, but let's also talk a little bit more about the risk real quick. What are some of the risks with Airbnb, Jack?
There's no risk. There's no risk in investing. It's just market always goes up. Everything's fine. Don't worry about
Get
it.
out of here.
I mean, there's everything. I mean, the market could turn. That's
market
one
could
of the
turn,
biggest
absolutely.
risks. Like appreciation doesn't happen all the time.
Yeah.
Which is people like to think the market always goes up over time. I
You
don't
also
disagree with
got-
you, but
Yeah, you get your different zoning regulations. One thing we wanted to stress last episode and really emphasize is you have to be
That
looking
one
at these
scares me.
resources and understand legislation and things that's happening in the community you're looking to invest in. I touched on it last episode in part 1 of this series. Arizona is a market we're looking at. Arizona, if you a simple Google search will show you how controversial Airbnbs in Arizona are right now. So you have to be mindful of these potential risks, these potential downfalls. And when you're underwriting these deals and looking at these opportunities, look at all the different exit strategies that come with all of these different deals and the ways you can or cannot really open yourself up to exposure. Because the last thing you want to do is lose capital. But it is investing and it does come with risk. The other thing we wanted to touch on again to circle back was one of the abilities that allow for the freedom is the systems and the processes. And we touched on that last episode. But again, reach out, get involved in the Facebook page. We'll talk about the technology. We'll talk about the resources in some ways in which you can really automate a lot of Airbnb, which I really appreciate because, as you know, with traditional multifamily, with self-storage, with warehouse and manufacturing, I feel like technology is obviously becoming a big piece. It's progressing.
Yeah, big time.
Airbnb really, because honestly, you're in the hospitality business, and what I'd be curious about, and I just had this thought right now, is how much of this has actually been borrowed from some of the better hospitality operators in terms of, the automated messages, leveraging the systems and the things that are out there. So that's just something to be mindful of too. Well, I can't wait any longer. Do you want to get to the special guest?
I'm kind of excited, so let's do it.
So the big one, if we're going to bring him in, and we'll have Chrissy, producer extraordinaire, bring on in. We have Kory Reynolds joining us. Kory is a real estate CPA for Baker Newman Noyes. I want to make sure I say that correct, Kory, because I actually just usually say Kory. And Kory's going to take a couple of minutes out of his very busy day to talk to the Tell Us Why community regarding the tax structure, the tax incentives, and some of the questions that go with Airbnb. So, Kory, thank you for being here.
Yeah, absolutely. I appreciate you having me on.
Yeah, and next time I promise I'll give more notice. So
yeah, more than yesterday afternoon. Yeah.
My great ideas come to me when they come to me. I can't control that.
That is a great idea. I'll give you that.
So yeah, thanks for being here, and thanks for just being part of this community. Kory comes to the meetups. He's really been involved. He's been instrumental in my investing career, and I this is a time to tell you and all the people listening at home, just thank you for always being a resource and a team player.
Well, I think he's one of the most detail-oriented individuals I've ever met, and one of the smartest. Can you disagree? Like,
he is.
I asked this guy a question, and I get emails that are so specific to every instance, and I'm in awe every time I
set him up for this massive thing.
He's
on the spot now. Kory, you better be detailed with every answer.
He's smart, is what I'm saying. And in real estate,
here,
in real estate, you want someone's real estate specific. So, going to your local CPA, like I did that for the first few years, and talked with Kory, and he was not too pleased with my situation.
That's right. And staying with that, one thing we've talked about, Keith brings on the ads, we had Catherine on, and now we have Kory. Your CPA, your attorney, your insurance agent, your property manager, if you're using one in Jack's case, these are team players. These are not just people you call at a convenient time. These are not people you wait till the end of the year and you give it. That's what you see bad operators do. You are investing. This is your business. This is your path for financial freedom. And Kory, in our case, or in your case with your CPA, you need to find someone who is a team player, who is a valued team member. And with that said, I will share a quick story. We were just talking about it before we came on air, why this is very important. We meet with Kory quarterly. I think we implemented that practice last year, and as we've grown, we're getting better and better as our business is evolving. And
you also call me about every week too. So.
We're gonna call bullshit on that one.
Yes. No, I call a lot. And as Hannah likes to point out, when the invoices come. But no, all jokes aside, you gain so much. Well, where I'm going with that is our Airbnbs were operating, getting a lot of appreciation, getting a lot of debt pay down, with the actual cash flow returns, we were actually kind of not operating effectively because I was making the mistake of kind of putting it on autopilot and saying, okay, well, yeah, I see the number. I'm focused over here. And then sure enough, one meeting with Kory, we completely revamped what we were doing with ours. And I kid you not, we 6x'd our return. Literally from this conversation, this meeting, and implementing these simple changes. And that's why these team members are so valuable. So
can we touch on for the Airbnbs?
Yes.
So what can we touch on a couple, or you want to touch on them after? Or?
We can touch on it real quick and kind of lead into the conversation. Essentially, we had bad debt that we refinanced. That was the biggest. We were not understanding. It made us take not even necessarily the tax-wise conversation with Kory. It made us go back and realize, okay, were we being had the market basically passed us growth-wise? Because our expenses had creeped up. We talk about that. We talk about operating expense creep. That happened. COVID happened, and Matt, Hannah, and I initially didn't want to lose any bookings. No one knew what was going to happen with COVID. So we slashed all our rates, and we maintained all of our bookings when in hindsight, demand went through the roof, and we had already locked in at a discounted rate. So we upped our rates, we upped our cleaning fee, we refinanced the properties, we kind of recalibrated and refocused after meeting with a CPA. This is not the investor, this is a CPA telling you. Because the thing about CPAs, whether you like it or not, is math doesn't lie, people do. And, Kory's just looking at the numbers you're giving him in the data, so he had a really objective view. And when I'm going a million miles an hour, like a lot of investors are, I'm not slowing down. And it was so crazy to me to see how quickly things can get away from you. And we made it a practice now where monthly we review all that data, when before they were on autopilot, we were kind of forgetting it. Yeah. And that's what I really want to talk about, those systems again. Systems aren't just in the operation of the asset. Systems are in the day-to-day cash flow management, operations internally on the administrative stuff. So that's another episode we'll get more into. But yes. So with that, we'll dive into it. What question do we want to fire at Kory regarding some Airbnb stuff here?
So, I mean, I'm selfish, and I want to buy Airbnbs where I want to go.
Okay.
So I say we kick it off with that, personal use limitations, things of that nature. Like, Mike, I know you have one in Montana. I have properties in Florida. I would like to go to, I don't know, Hawaii, South Carolina.
Of course, you can just go all year, right, Kory?
Spend the entire year there.
How's it work with the personal use stuff?
Yeah, and I think this is where a lot of people do get into the Airbnbs. Like, oh, I'd really like to have that place in Florida, but it'd be nice if it paid for itself. And I think this is almost going back to some of the systems you discussed, where it's like, oh, you had these properties, they're in good locations, you had good appreciation, but, kind of break even cash wise, plus minus. You're like, okay, but it still felt like upside because there was a lot of appreciation. But I think that's how a lot of people start looking at these rentals. Like, well, if it breaks even, then I'm good to go. But having those systems in place will make, on my case, I think Mike gives me a little too much credit in his example. All I did is say, when I look at the return you're getting on these versus what you have over here in the multifamily, it's not making sense right now. And that kind of struck off the whole list of changes that they did on their own. I can't take credit for anything they did on their end, but I think it's important that I can start that conversation and bring it to their attention, where folks have the emotional attachment to the asset, where it's like, this is my first property I purchased up in Maine. It's a great neighborhood. It looks good. And then if someone comes in and says, well, you're making, your return here is 2-3% on your money. It's like, why over on this other side, you're getting 20-30%. That helps open up what you're, helps you re-examine what you're working with. And I guess I can actually return to Jack's question now, as far as, after you get these Airbnbs, what are your considerations from a tax standpoint for personal use? So there's really several different buckets that you fall into, and each of these are tested on an annual basis for an Airbnb property. Okay. So the first would be the simplest, which is, and if you buy a property purely for Airbnb, you're not going to use it personally at all. Well, at that point, it's just a strict rental asset. So there's nothing special that's going to happen in your allocations between personal use and business use, because it's all business use at that point. And the next level that you see is where you have a minimal amount of personal use. So if you have the formula is 14 days or less of personal use, or less than 10% of the days rented. So if you look at, I rented it for 250 nights during the year, well, I can use it 25 days personally without any penalty, or without and fall under kind of this bucket. Or if it's, say I only rented it 30 nights and I used it 13 days personally. Okay, well, I'm not at 10%, but I'm at 14 days or less of personal, so I'm going to fall into this bucket. And this bucket for allocations is just looking at, well, how many nights did you rent it? How many nights did you use it personally? The total, and then the percentage. So say you used it for 10 nights, you rented it for 20. So your personal use is 33%. So really all of your indirect expenses, 33% is not deductible against your rental income. And there are certain ordering rules that applied on the types of expenses. And the thing to keep in mind on that as well is, some expenses, and this is actually something that we see missed on a regular basis by people that this is not their focus, is that some of these expenses really are direct expenses and you don't have to allocate those. Like if you look at the advertising for your Airbnb, your cleaning fees after people come, those are not personal use expenses at all, so they can be taken at 100%. What's needs to be allocated is really the stuff that's allocated to the property, well, the full property. So say your maintenance and repairs is the biggest one there. Your utilities, a lot, those types of expenses. And then even there's a different allocation that you can use looking at your real estate taxes in your real estate taxes, insurance, and mortgage interest, where the IRS will actually let you apportion based on, okay, well, these are the number of days that you used personally over versus the entire year, instead of just the bucket of the days that the properties were used. And that's something you can look at and say, oh, which way gets me the better result? And that's something that we'll usually look at with someone. And depending on the makeup of those expenses and where they are, maybe they get better with that apportionment, maybe they don't, but it's always something I like to take a look at. So.
And this also ties in, Kory, to jump in right there. One thing, and again, I'll circle back to my personal life because we like to give examples.
Yeah.
We just came up to this because this is going to show up again, and this is very important for the community to understand. As I mentioned, we're selling one in Montana, we're buying another one. We actually thought we were going to do a 1031 exchange, and thank God we have systems in place to reach out to research. And good.
What's a 1031 exchange?
Oh, okay.
Since we have the CPA
Yes.
on
What is a
there.
1031 exchange, Kory?
For those
That's a
that
good
don't
point,
know, we
Jack.
might as well define it.
That was great. Good job.
Thank you.
Yeah, so very good segue there. So 1031 exchange is a like kind exchange is kind of the more common man way to refer to it, but it's essentially exchanging one piece of real estate for another piece of real estate. Doesn't need to be direct. It's usually done through an intermediary. So you sell your one property, the proceeds go to this intermediary, then you go and buy another property. And what that allows you to do is defer that gain. So you could have a $200,000 gain in that old property, and then essentially you move that gain over into the new property and don't pay any tax on it in the year of the sale. So you essentially save that gain within the new property, that if you sold that new property not in a 1031 exchange, you would end up recognizing that $200,000 of gain plus any additional appreciation. But it defers that tax, and it gets the going theory is, this is where you say that the best tax planning strategy is death. If you can 1031 forever on your properties, eventually you pass away.
Chrissy agrees.
And it's stepped up, no one ever pays any gain on the appreciation of your property.
Awesome. And again, that was a perfect segue into where I'm going with this. Is we engaged Kory at the same time we engaged the 1031 attorney in Montana. He was great to work with. And unfortunately, I made the mistake of thinking it was calendar years when it was placed in service days. And we came up, I kid you not, I think we were like 3 days over, something like that. So now we're going to have to pay capital gains because of the personal use. And another quick tip for the community. As I asked Kory, because as everyone knows, I absolutely hate paying taxes. I thought, well, wait a minute. A couple of these months, we were stabilizing it and getting it ready. We weren't actually on vacation. We were working. And he's like, unfortunately, the IRS doesn't care about your feelings or your theories. This is considered personal use. So when you go to plan your exit, we always say start with the end in mind. And actually, Kory, that leads me to a great thought I just had to kind of put you on the spot.
Uh-oh.
That personal usage, if I recall what you said, that's a 2-year look back, correct?
Yeah, so the IRS, what's important with a 1031 is the asset must be investment or business use. So when looking at a property that's used as a vacation home, the IRS created this safe harbor, which looks at the 24 months prior to when you are selling the property and what your split of personal versus business use was during that time.
So hypothetically, again, we're always talking about exit strategy. Start with the end in mind. Jack has his property in Florida. He plans to exit maybe in the next 5 years. He might want to be mindful of 2 years prior. Maybe he doesn't go down there for those 2 years. Or another question, because I never thought of this, could you in theory charge yourself the nightly rate if you know you're going to get that back on taxes? Because that's not a discounted rate, right?
I would not go there.
Okay, we won't go there. I told you, I once a week I try to go to jail.
Mike does his best. He has a lot of ideas.
Kory and Catherine keep me out of a lot of trouble. So I'm a creative guy. What do you want from me? So where I'm going with that is that's something for the exit strategy that we just thought on this call that you're getting out of this. So make sure you go back and listen to that again. Be mindful. If you're going to inherit a family property, Lakes region in New England or somewhere else across the country, wherever you're investing, be mindful of when do I plan to exit this? What is my strategy to implement to be mindful of use? That was great. What is the next one I want to fire at, Kory?
So talking about character of income, short-term rentals are not always classified as rental income. So let's touch on that.
All right.
Yeah. And I think, actually there was a couple more things on kind of splitting and allowing the deductions on the losses depending on your personal versus business use, which actually plays into the character of income piece.
Oh, absolutely.
So, I'll talk on that for a second. So we kind of talked about the buckets where you have where it's 100% business use, where you have a little bit of personal use. So if you have a little bit of personal use where you're under those thresholds, any losses you have in that property are actually allowed after determining your allowed deductions. If you have a tax loss, you can use it to offset other sources of income subject to other limitations, of course, but it at least gets out of the rental property and is available elsewhere. And that would be important if someone qualifies as a real estate professional as well, that they'd be able to use those losses. Then if you go into kind of the next category where you're over those thresholds, you're using it quite a bit personally, then that's when you move into a world where for losses where you're subject to another regime where they say you can't create a loss with this property. You can't have a loss because so much of it is used personally. Vacation home loss limitations, and those thresholds are very similar to what Mike ran into with his 1031 with the 14 days of personal use or 10% of days rented. If you're kind of over those thresholds, then it's okay, predominantly personal use. That's how the IRS is going to look at it. So they don't want you being able to create a tax benefit for yourself because of your vacation home, which is, and because of the amount of personal use you have, they say, this really isn't an investment asset for you, no matter how you might feel about it. And there certainly are facts and circumstances where you could make that argument, but you'll have a steep hill to climb a lot of the time. But those losses are disallowed, and while they're disallowed and carried forward, they're only carried forward for to be used against income from that same vacation home rental activity. So it's not like, if it's 100% business use or just a little bit of personal use, those losses can be carried forward. They can be used up against other sources of income. If you're over those personal limitations, it's just locked up. It stays in that rental property. And then upon the sale of the rental property, usually those losses really just dissipate instead of being released and allowed against all your other sources of income.
Which is huge if these are, if you say you're doing well. I'll give an example, Kory, and you jump in if I'm incorrect, to put it in the layman terms. If you're using some of your real estate professional, paper losses, if you will, for lack of a better term, and you exceed this personal use limitation, you're not going to be able to reap any of the benefits from depreciation or anything else from this Airbnb because they're going to be tied into that personal use to that property only. Is that a pretty good way to summarize it?
Correct.
Awesome.
It's the same thing if someone isn't a real estate professional, but maybe they just have a few other rental properties. If they're over those personal use thresholds, even though they're not a real estate professional, if they have rental losses, they could still offset them against other sources of rental income. But if you're over those personal use thresholds, it's locked up and it can't be used against any of your other sources of rental income.
Gotcha. And that leads kind of the big one that I want to ask about, the one that I'm still confused about myself because it just shows how complicated it is. The Airbnbs, and we touched on this, these are, when you're operating them, and I don't know all the factors that tie into it, these can be considered hospitality, which under the current code that I think was passed in 2018, I don't know if it expires in 2022, correct me if I'm wrong, you get 100% bonus depreciation in year one, correct?
That is, oh yeah, on assets with less than a 20-year tax life, yeah, it's eligible for 100% bonus depreciation.
Okay, and why is that beneficial to Airbnbs?
Well, and this leads into what Jack brought up as far as the character of the income. Depending on how involved you are with your Airbnbs, if there's services being provided, amenities being provided, along with the fairly short stay, the IRS can actually classify this as self-employment income. So being self-employment and ordinary income. So note that this is no longer rental income, which is always considered
passive.
It's always considered passive. So it's ordinary income. So even if you have losses and you're not, they can offset your wage income or other activities. So if you can create those losses, it could potentially offset your normal sources of income where that may not be possible with a regular rental activity. So the bonus depreciation could be a big piece of that. And then it's going to also depend on really the facts and circumstances, what's going on. If you have the one-off Airbnb that you just bought because you want to go vacation down in Florida and, you're hoping it's going to pay for itself and the management company's taking care of everything, probably you'd have a hard time claiming that those losses are, truly ordinary or self-employment losses and can reduce your other sources. But if you're someone that you own half a dozen Airbnb properties and this is a big part of what you're doing is managing and running these, then you provide some amenities to your tenants. Okay, well, the facts are stacking up in your favor that you're going to be able to use these losses, really tax losses when you're looking at a bonus depreciation to offset your other sources of income, whatever they might be.
And that's unbelievable. And, go back and hear that again. And to make that clear, essentially, this is where I go back to what we started the conversation with, is having the conversation. When you're buying an asset, we call it optimization. You can call it whatever you want, but are you positioning yourself? And this takes time. We didn't start like this by any means. We've grown into some of this where now, it's to the point we actually have an optimization checklist for every building. We have a quarterly optimization report. And we have a yearly optimization report. And one of the reasons is, are you aligning everything correctly? So if you do go down to Florida and you want to buy one, you hop on a call with Kory, you hop on a call with Catherine, you hop on a call with Keith. How are we positioning this to make sure, we're in the best position? Because also, taxable income, that's money coming out of your pocket. That's affecting the bottom line in your investment. Every dollar you're paying in taxes is a dollar you don't have to invest. And to stay ahead of inflation, to stay ahead of your goals and really attain that financial freedom we talk about, you need to find these dollars. And this is also why I say it all the time. There's three people you don't get cheap with. It's your CPAs, your attorneys, and your insurance guys. Because if you want that level of information, that's kind of showing the returns. I think that was a great answer. Thank you, Kory.
All right, I just have one last question.
And we'll get him out of the guy. I promised him 10 minutes. He's gone over.
I know.
We're getting billed now.
Again,
Exactly.
selfishly, Mike's on the spot here. So what about family and friends? Can I buy an Airbnb and let my family use it as much as they want? Because I'm not using that. So that won't count against the 14 days. Can I go to Mike's property for the next 3 months and he can't do anything about it? What's the tax implications?
That'd be great, wouldn't it? Yeah.
I'm doing him a favor by going on vacation to his
Chrissy
property.
and Jack are going to Montana on me, apparently.
So the rules on it when they look at personal use is any days but used by you, your family, your friends.
We're not friends. It's cool.
Whoever it might be that are using that property for less than fair market value rent. So maybe you're going to give your friend a little bit of a discount and you're going to say, oh, well, that's close enough to fair market value. I wouldn't stress too much about that. But, if you're letting your friends stay there or whoever for no rent at all, then that's going to count as a day of personal use, even if you aren't there. And I think the other thing that's important here, and this came up in conversation with someone recently, is say that you have multiple owners or partners on a single property. So if you look at, say this is Mike and Jack's property, say Mike's family goes off and uses the property for no rental use. Well, that still counts. For Jack, that's still
Cory,
personal
you can
use,
tell the
even though
people
Jack
that was
and
me.
I-
I asked you a hypothetical. I was trying to get around that 14-day thing so much. I'm like, well, what if they get a week and I get a week? And he goes, no, they count it as all. Again, we were not kidding
Exactly,
here.
yeah.
I call
they
a lot.
look at it as the use of the property rather than who each specific owner in their own personal use. It's just the owner group as a whole.
That's
and
awesome.
that 14-day or 10% limitation.
That's awesome. Well, I don't think Cory, I don't think we can thank you enough for being here. This was unbelievable. The community thanks you. We thank you, and we hope to have you on again in the future and helping. And Cory, one last thing: if you do want people to reach out, what is the best way to get a hold of you? Where can they get some more resources? What would you recommend? Bigger pockets, personal stuff, social media. Where can they find you?
Yeah, absolutely. So I'll send you some information to put in the show notes as well. But they can reach out to me by email, phone, whatever works for you. And we're always willing to have a conversation with people for potential new clients or just keeping in touch with people as they're growing. So just reach out. Let me know what you have going on.
That's awesome, Cory. Thank you so much for being here. We really appreciate it.
Perfect. Thank you, Cory.
All right, that was awesome. Wow, so many good answers. So much good knowledge. I mean, I don't know how else you can go and get into it and why you kind of need to prepare.
I mean, just having someone like that on your team is instrumental to your long-term success.
Absolutely. The guy's a monster. I tell everybody.
Yeah.
So with that,
I mean, I think that went a little bit longer than we were anticipating, but
so where can let's do our regular stuff for those who are checking out this episode and other episodes. Where can they find out more about the Tell Us Why?
you can find us on YouTube, Instagram, Facebook, social
Soon
media.
TikTok. We keep saying it. We're gonna do it.
I don't know. Are we getting on TikTok?
We are going to get on TikTok.
All right, we're doing it.
Even better if you're in the area.
If you have any questions about this or anything specific, Facebook group is the best question to ask.
Yes, fire
best
on
place
Facebook.
to ask those questions.
And if you want to check us out live in front of the studio audience, we record most Wednesdays at the Studio 21 Podcast Cafe in Salem. And we've got a
Wrap
quote
it
of
up
the
with
week.
the quote of the week. The great aim of education is not knowledge, but action. I love that one. That's a really good one.
He did it.
He did do it. First one without stumbling.
You said that 3 weeks
Yes!
in a row.
Yeah, you
All
kind
right.
of still fucked the other one.
So
That was
like
Herbert
that.
Spencer. So that's it for today. Join us next week. And until next week,
bet on yourself.
The views and opinions expressed by the hosts, guests, or callers of this program do not necessarily reflect the opinions of the Studio 21 Podcast Cafe, the United Podcast Network, its partners, or affiliates.